안녕하세요. 글로벌 시장에서 통하는 투자법을 알려드리는 뉴욕나우 한국경제신문 강영연입니다. 오늘은 존 메이어 글로벌X 최고투자책임자와의 인터뷰를 준비했습니다. 메이어 CIO는 월스트리트에서 25년 동안 일한 전문가입니다. 이전에는 메릴 린치, 뱅크 오브 아메리카, UBS 등에서 일했고 2017년부터 글로벌X에서 CIO로 근무하고 있습니다. 지난번에도 한번 인터뷰를 했었는데요. 그때와 시장과 경제 상황을 보는 시각이 어떻게 달라졌는지 비교해보면서 들으시면 좋을 것 같습니다.
And we had an interview last December.
Right.
Yeah, at the time I asked about the market outlook. From then, there are many changes, so
Yes.
especially in macro environment, tremendous changes. So I want to ask about at first. First of all, I remember that you expected recovery, market equity can support the market. However, the equity market is falling sharply in this year, and both Nasdaq and S&P 500 entered the bear market. And what do you think is the cause of the unexpected bear market?
The world certainly has changed a bit since November and December, and the market is contending with many different issues. We have obviously inflation. Inflation is very high. I believe when I spoke last time, I indicated that inflation may peak around 6%. Actually, core inflation is approximately 6%. Headline inflation is closer to 8%. What we have is a situation where we have a tight labor market, which is causing wage inflation. We have food inflation, which is being exacerbated by a war in Ukraine. We have, which feeds into higher energy costs, kind of feeds into the whole ecosystem. And higher energy costs are creating more inflationary pressures for the consumer. So combine that with a Fed, the US Fed, having to contend with these issues. The Fed has to bring inflation down, and I believe they have been behind the curve. And what they are doing right now is trying to play catch up. And actually today, they indicated they may actually go beyond neutral to try to bring inflation down. And actually the markets are actually responding positively to that news because the markets wants inflation to come down. And if it can come down sooner, then we could have a more normalized market going forward. And I think that's what we're dealing with right now. What's going to happen with higher interest rates? With higher interest rates, obviously, you're going to have risk assets be priced down because the cost of capital is going to be higher. And that has caused a lot of uncertainty, combined with the war, combined with all these inflationary pressures that we're dealing with right now. So we are in a bit of a different environment, and inflation is proving to be more permanent, more ingrained than we initially thought. We initially thought it would be more transitory, and that's proving not to be the case.
Okay, I think my next question should be about inflation. Of course, you said before in December you expected the imbalance between supply and demand would be resolved and inflation would be eased by the middle of this year. But however, as you can see, the inflation figures are still very high.
Yep.
And you mentioned before the Ukraine war is one of the reasons that high inflation caused that. What do you think the reason is for this kind of high inflation?
Well, we have a world that we're living in now that is not quite post-pandemic, but in most parts of the Western world, we're trying to get back to normal. But we're still reliant on different parts of the supply chain from different parts of the world. So in China, you're continuing to see lockdowns. Shanghai has been in lockdown almost 2 months. There's rumors that Beijing may come under lockdown as well. So that is exacerbating the supply chain problem. You combine that with a lot of demand. People have been home. People have not been able to kind of live a normal life until more recently. And there's been a lot of demand for products. What we're seeing now is kind of a shift from products to more services. But the fact is that there's been because of the supply chain issue, combined with the fact there's a war in Ukraine that is exacerbating higher energy costs. Those are some of the reasons that you are experiencing higher inflation right now. So what the Fed is trying to do is to reduce demand. The Fed can't do anything about the supply side, but they can potentially control the demand side. You bring rates high enough, then the consumer will feel more strapped and they'll buy less. But what you're having in the US is a very tight labor market, and that's also exacerbating and feeding into inflation. And the inflation rate is very low in the US. And I would argue that the Fed is actually trying to bring up bring up the unemployment rate. But it's still very tight right now.
Then when do you think the price could be normalized?
That's a harder question. Before I said sometime in the middle of 2022, certainly that's going to be extended out. I'm not going to put a time frame on it because we are still at the beginning of the Fed rate hiking cycle. They've actually only raised rates 75 basis points at this point. So sometime I would expect, and sometime in 2023.
I want to talk about the tech stock next. How low tech can go? I think that's the question on everyone's mind.
Sure.
As the ones high-flying stocks of tech company and the darling of pandemic continue to plummet. In 2022. So in the last interview, you had a positive view on tech stock. Are you still optimistic on tech stock at this point?
Well, it really depends on which part of the technology spectrum. So there's definitely quality type technology companies, the Apple and the Microsofts of the world. And those companies, while they certainly have come off in price approximately 20%, I believe that the companies, those type of companies that are much less reliant on capital markets, so they don't necessarily have to contend with higher funding costs because they're very well capitalized. They have the ability to pass on some of the higher cost, the raw materials to the end user. Those types of companies are better positioned. Doesn't mean that the price can't come down, but longer term, I think they have a much better chance of a quicker recovery than other companies that are much more reliant on capital markets. Now, innovation is going to continue. Technology doesn't just stop because markets go down, but it does pose some unique challenges in terms of, can the consumer buy some of these goods? Can businesses grow as fast? And can they fund their businesses effectively or cheap enough because rates are higher? So quality technology companies certainly are going to do fine going forward. I'm not going to say over the next 2, 3, 4 months, but over the over 1, 2, 3, 5 years, I believe that quality companies certainly will prosper and continue on their path.
Could we say it is the chance to buy the dip, that kind of quality company?
It's tough to say buy the dip. So we hit bear market territory for a brief moment. Could we go down further? Absolutely. I think we could absolutely go down further. And if you look at some technology names, you look at the prices pre-pandemic, they were still lower than where they are now. So I think there potentially is some downside. Sure.
And not only you, Serf, but also most of the experts in the market, they expected the first half of this year is strong in stock market, and after the Fed starts rate hike, and then the equity market will be weaker than before. But as you can see, the market is weak in the first half of this year. So what do you expect for the rest of this year? And moreover, you said S&P 500 will rise to 8 to 12% at the end of this year. And do you still hold that opinion?
I don't think so. I do think that markets overcorrect.
Yes.
And then they rebound rather quickly. It's unclear right now if we've reached the bottom. If you look at kind of the patterns of selling, first you saw the institutional sellers, hedge funds, they sold earlier on. Then you saw retail sell, which is typical. Retail usually comes after the institutional selling. And there's still a good amount of short positions on both from retail as well as institutions. So that would lead me to believe that market participants don't believe we're currently at a bottom. So I would say we still have some downside from here, and then markets will begin to recover. I'm not going to put a price on a percentage on where we're going to be at the end of the year, but I think potentially we have some more downside before we see an upward trend. Markets always look forward, and as I said earlier, that the Fed has only acted on 75 basis points and increased so far. They've indicated that they're going to increase 50 basis points at the next meeting and likely the meeting after that. So markets do look forward. So today you're seeing a market as of, right before we came on this interview, that the markets were doing rather well in a reaction to what Powell was saying. And again, markets look past the short term. They're looking at 3, 6, 9 months into the future. But I still think we have some downside first.
What do you think about the possibility of recession or stagflation?
Yeah, the risk of a recession is rising, but it's still approximately 30%. So I think that is, the CBO, the Congressional Budget Office indicated that GDP growth will be 3.1% this year. It's certainly not a recession. Technically, a recession is 2 quarters of negative GDP growth. We did have a negative quarter last quarter, but I believe there are some distortions in those numbers, and we'll likely see a positive print for the second quarter. Recession risks are rising, and we do believe that growth will decelerate. That makes a lot of sense because that's what the Fed is trying to do. They're trying to curb demand, and if you curb demand, that's certainly going to change the growth prospects.
We've obviously seen tremendous volatility in the equity market, and the volatility seems to continue for a while. And in this situation, how should investors respond to this market? And if you look around the market, are there things or industry that you are particularly positive or negative on? Sure.
What's interesting is actually equity volatility is not as high as you would expect. The VIX is, approximately 29. If you compare that to the pandemic in March of 2020, the VIX was meaningfully higher, high 70s, low 80s. So equity volatility is not that high. Interest rate volatility has been high, but has been declining. So just to level set, with respect to going forward, I think everything mean reverts over time. So markets, we believe, got ahead of themselves. And markets, what is this? What is a stock price? A stock price is a cash flow of future earnings. So in certain areas, if you're seeing earnings decline, then it makes sense that a stock price would decline as well. So going forward, and what we've been saying most of the year, is that we are recommending to clients to buy quality. Quality got sold off just as much as everything else. Maybe in terms of actual return numbers, slightly less than higher growth areas, but quality did get sold off. So going forward, we're not saying anything different than we said in the beginning of the year when we came out with our outlook, is that we believe that investors should focus on quality, focus on companies that have strong earnings potential, are able to pass through higher input costs. So pass on, if they're higher commodity costs, higher semiconductor costs, whatever it may be, onto the consumer, and are less reliant on the capital markets. So those are the type of companies, the characteristics of companies that we are looking for.
Is there anything, because your company focused on thematic ETFs, so?
Sure. We believe that it's been highlighted by the war in Ukraine. Europe is very reliant on Russia for energy. Approximately 40% of their energy needs, Europe's energy needs, comes from Russia. That's a situation that nobody thinks is sustainable long term. So that highlights the fact that many countries need to be energy independent. And to be energy independent, you have to rely on clean energy, some component of clean energy. And that falls into clean technologies for solar and wind, as well as electric vehicles. And we believe that lithium, which is the element that is needed for batteries that supplies the energy for an electric vehicle, that element is in great demand right now. And lithium prices have gone up, quadrupled in the recent past. So the commodity lithium, we believe, makes a lot of sense. Electric vehicles, the adoption of electric vehicles has been increasing and will continue to do so, as you're seeing many automakers around the world transition from the combustion engine to the electric solution.
I think it is my last question, and with the question on crypto. I remember that last time you said cryptocurrency is a highly volatile but remarkable area.
Yeah.
Yes, and do you still hold that opinion?
We do.
And what is your forecast about crypto market?
Sure. Cryptocurrencies have proven to be very volatile. And you've seen a drastic decline in price for Ethereum, for Bitcoin. But what I'm looking at more is the technology behind cryptocurrencies, the blockchain technology. I think that's an important component, and you're going to see that in many different businesses going forward. Now, cryptocurrency as a currency, because of the volatility, calls into question, can it be used as a currency? And some of the instability in some of the stable coins, which were thought to be more stable, because they are called stable coins, proved to be not as stable and not as reliable. So there's work to be done within the crypto space, but it's playing a large part in financial technology companies. And I think that it's an area of great focus. Doesn't mean that it's not going to come with great volatility.
And you have a positive opinion on crypto market because of the blockchain technology?
Because of the technology. The technology is not going away. Could some of these currencies go away? Possibly. I don't think Bitcoin is going away. But there has to be a solution to make them to be an actual currency for them to be more stable.
Mm-hmm.